Hello CA final students. In this video, I will discuss with you all the amendments that are applicable for May 2026 attempt. Finance Act 2025 is applicable for May 2026 attempt, and whatever the amendments that are there as per Finance Act 2025 and circulars and notifications issued up to 31st July 2025, all those amendments are covered in this PDF. Whatever the amendments that you are seeing on the screen is there, entire amendments are given to you at free of cost. You can download this PDF as a link to this YouTube video. So shall we start discussing the amendments? First amendment is change of slab rates. Under optional tax rates, slab rates are same. But under default tax rates, slab rates got changed. So in case of individual, HUF, AOP, BOI, AJP other than cooperative society, for these category of persons, there is change in slab rates. Earlier, up to 3 lakhs, 3 lakh to 7 lakhs, above 7 lakh to 10 lakh, above 10 lakh up to 12 lakh, these slab rates are there. Forget those slab rates. Whatever the slab rates that I am teaching right now, only remember those. Like what are the new slab rates? In case of individual, HUF, AOP, BOI other than cooperative society, under default tax rates up to 4 lakhs there is no tax. So under default tax rates nowadays basic exemption limit is 4 lakh rupees. Up to 4 lakhs there is no tax. Above 4 lakh up to 8 lakh tax rate is 5%. Above 8 lakh up to 12 lakh tax rate is 10%. Above 12 lakh up to 16 lakh tax rate is 15%. Above 16 lakh up to 20 lakh tax rate is 20%. Above 20 lakh up to 24 lakh tax rate is 25%. Above 24 lakh tax rate is 30%. Very easy and very simple to remember. For every increase in 4 lakhs, tax rate also increases by 5%. Up to 4 lakhs, there is no tax. For 4 lakhs, add another 4 lakhs. Above 4 lakhs, up to 8 lakh, tax rate is 5%. Above 8 lakh, up to 12 lakh, tax rate is 10%. Above 12 lakh, up to 16 lakh, tax rate is 15%. Above 16 lakh, up to 20 lakh, tax rate is 20%. Above 20 lakh, up to 24 lakh, tax rate is 25%. Above 24 lakh, tax rate is 30%. I hope you understood. Next, I will discuss another amendment. Go to the last page, 32. Income on redemption of ULIP, Unit Linked Insurance Policy, ULIP. You know, right? If you take Unit Linked Insurance Policy, maturity amount is exempt under section 1010D. We have discussed in chapter 6A deductions. If LIC policy is taken before 1st April 2012, actual premium or 20% of sum assured, whichever is lower is eligible for deduction under section 80C. And if actual premium is less than 20% of sum assured, then maturity amount is exempt under section 1010D. Do you remember? We have discussed. So, if you take any LIC policy before 1st April 2012 and actual life insurance premium is less than 20% of sum assured, then maturity amount is exempt under section 1010D. Likewise, if you take policy after 1st April 2012 but before 1st April 2013, then only 10%. If actual premium is less than 10% of sum assured, then maturity amount is exempt. So, like whenever maturity amount is exempt, well and good, it is exempt under section 1010D. If actual premium is greater than 20% of sum assured, if actual premium is greater than 10% of sum assured, if policy is taken after 1st April 2012. In that case, it is no more exempt under section 1010D, it is taxable. Under which head it is taxable? It is taxable under the head capital gains. Clarification is given in Finance Act 2025. So you can see ULIPs which are not eligible for exemption under section 1010D are treated as capital assets. Income on redemption of such ULIPs is taxable as capital gains. Are you able to understand? So the point is, if actual premium is less than 20% of sum assured or less than 10% of sum assured, then maturity amount is not taxable. Maturity amount is exempt. If actual premium is greater than 20% of sum assured or greater than 10% of sum assured, in that case maturity amount is taxable. Are you able to understand? Good. Where under which head it is taxable? That maturity amount is taxable under the head capital gains, and unit linked insurance policy is also treated as capital asset. You can see equity oriented fund definition also changed. Equity oriented fund amended to include such unit linked insurance policies for which exemption is not available. So those ULIPs, unit linked insurance policies, for which exemption is not available, they are treated as equity oriented fund, because equity oriented fund definition is amended and equity oriented fund includes those policies for which 1010D exemption is not available. Are you able to understand? Deduction under section 80 CCD for unified pension scheme. You know 80 CCD, right? Generally, contribution to NPS is eligible for deduction under section 80 CCD. In chapter 6A deductions, we have discussed employer contribution is eligible for deduction under section 80 CCD 2. Employee contribution is eligible for deduction under section 80 CCD 1 and 80 CCD 1B. So once upon a time, government used it to give pension, but afterwards government is, even though you got government job, after retirement you are not going to get the pension. So that's why the government introduced the concept of NPS, Central Government Pension Scheme, NPS. Now, along with NPS, from 1st April 25, they introduced another scheme called UPS, Unified Pension Scheme. Now, what government is saying, in case of central government employee, he has two options. Either he can contribute to NPS, option 1. Option 2, he can contribute to UPS, Unified Pension Scheme. If he contributes to NPS, he is eligible for deduction under section 80 CCD. The same benefit is available even if he contributes for UPS also. Are you able to understand? That means what? Not only contribution to NPS, even if any contribution is given to Unified Pension Scheme, even that contribution is also eligible for deduction under section 80 CCD. So from 1st April 25 onwards, central government employee, he opted for Unified Pension Scheme. Central government will contribute for Unified Pension Scheme. Central government employee will also contribute for Unified Pension Scheme. Whatever the contribution to Unified Pension Scheme is there, even such contribution is also eligible for deduction under section 80 CCD. Are you able to understand? That means what? Very simple. Whatever the benefit of deduction under section 80 CCD is there for NPS, the same benefits are extended to UPS also. Even contribution to EPS is also eligible for deduction under section 80 CCD. Normally, NPS, UPS. NPS is market based return. Unified Pension Scheme is fixed. See, when return is dependent on market, contingency is there. If there is risk, you will get lower return. If there is no risk, you will get higher return. But like after retirement, what any individual will think, he wants some secure monthly payment, correct? So like central government employees, if they want to take market risk and they want to enjoy market return, they can opt for NPS. If they want fixed payment every month basis, they can opt for UPS. Any option, whether NPS option or UPS option, whatever the central government contribution and central government employee contribution is there, under any options, such contribution is eligible for deduction under section 80CCD. Are you able to understand? Good. Next. You can see unified pension scheme is introduced as an option under NPS for central government employees covered under NPS. The objective is to provide an assured monthly payout after retirement. If they choose NPS, monthly assured payment they will not get. Based on market, they are going to get the return. But if they choose UPS, like monthly fixed amount will be paid as a pension to the central government employee after retirement. Both central government employer and central government employee can contribute to UPS, is allowed as deduction under section 80CCD, just like NPS. Any amount including accretions received from UPS by SSC or his nominee on superannuation, voluntary retirement, for which deduction is earlier claimed, is taxable as income in the year of receipt. So whatever the amount that they are claiming as deduction today, in future they are going to get back that amount now. In the year in which they receive that amount, in that year it is taxable as income at the time of retirement or superannuation. You can see. But lump sum withdrawal from UPS, individual corpus, at the time of superannuation or voluntary retirement or retirement is tax exempt up to 60% of the individual corpus, contributions plus accretions. Lump sum amount received by UPS subscriber at the time of retirement is exempt from tax. See, there is little bit of confusion in between these two sections. I will clear that confusion. I will draw one chart. You will get clarity. Before that, we will read this note point. Lump sum guaranteed payment will be allowed on superannuation at the rate of 10% of monthly emoluments for every completed 6 months of qualifying service. So there is this definition. See, central government employee chose UPS. He got retired, superannuation. That means he completed retirement age of 58 years or 60 years or 62 years. He retired, completed age. Now at that time, like let's say he withdrawn total amount. Out of total amount withdrawn, whatever the lump sum guaranteed payment is there, lump sum guaranteed payment. Sir, how much is lump sum guaranteed payment? Like 10% of monthly emoluments for every completed 6 months of qualifying service. So whatever the lump sum guaranteed payment is there, lump sum guaranteed payment, this is fully exempt. Under which section? That is fully exempt under section 1012AB. Okay, next. There is balance amount now. Out of balance amount, to the extent of 60% of individual corpus. Individual corpus means employee contribution. What central government employee contributed over a number of years. So, individual corpus plus accretions. Accretions means what? Interest on such contribution. Very simple. 60% of central government employee contribution along with that interest. Whatever this amount is there, this amount is exempt under section 1012AA. Okay. Out of remaining amount, which was claimed as deduction earlier, which was claimed as deduction earlier, that is taxable, remaining is not taxable. Are you able to understand? So let's say he withdrawn total amount, let's say 1 crore rupees. Out of 1 crore rupees, there is the guaranteed payment, like calculation is there. You can see 10% of monthly emoluments of every completed 6 months of qualifying service. You can do that calculation. Whatever the guaranteed payment is there, that is fully exempt under section 1012 AB. Now, let's say it is 20 lakh rupees, it is fully exempt. Balance 80 lakh rupees is there. Out of 80 lakh rupees, whatever central government employee contribution every year is there, along with that interest on it, let's say 30 lakhs is there. That is like 60% it is exempt. Whatever the balance 40% plus other amount is there, from that whatever the deduction that was claimed earlier is there, that is taxable, because you can see this point 80 CCD 3A, any amount received from UPS by SSC or his nominee for which deduction was earlier claimed is taxable in the year of receipt. So that is going to be taxable, remaining amount is not taxable. Are you able to understand? Good. See, these two are additional amendments. Remaining all amendments I covered in CMA final DT amendments. So, like from second point onwards, whatever the CMA final DT amendments is there, that video will come. Every amendment is covered very clearly. Watch this video till the end so that all the amendments will get covered in this video. Next, rebate under section 87A. There is an amendment. You know, rebate under section 87A is available subject to satisfaction of some conditions, and rebate is available both under default tax rates as well as under optional tax rates. Under both tax rates, rebate under section 87A is available. First, let us see under default tax rates. There are three conditions. SSC must be individual, condition 1. Individual must be resident in India, that is condition 2. Resident can be resident and ordinarily resident or resident but not ordinarily resident. Condition 3, if total income is less than or equal to 12 lakhs, then how much is the rebate? Rebate is 100% of tax or 60,000, whichever is lower. Sir, we will do one problem so that you will understand this better. Let's say there is Ram. He is a resident individual. His total income is 11 lakhs and he is paying taxes under default tax rates. You know, under default tax rates, just now we have discussed up to 4 lakhs nil, above 4 lakh up to 8 lakh 5%, above 8 lakh up to 12 lakh 10%, above 12 lakh up to 16 lakh 15%, above 16 up to 20%. You know these slab rates, right? Correct. So his total income is 11 lakhs. So up to 4 lakhs tax is 0. Above 4 lakhs up to 8 lakh tax rate is 5%. 4 lakh into 5% tax amount is 20,000. Above 8 lakh up to 11 lakh tax rate is 10%. That means what? 3 lakhs into 10%. Tax amount is 30,000. So tax is 50,000. Three conditions are satisfied. SSC is individual, condition 1 satisfied. He is resident in India, condition 2 satisfied. His total income is 11 lakhs, which is less than 12 lakhs. Condition 3 also satisfied. So he is eligible for rebate. How much is rebate? Rebate is tax or 60,000, whichever is lower. Tax amount is 50,000. 50,000 or 60,000, whichever is lower, means rebate is 50,000 and his net tax liability is 0. Did you understand? Yes. Perfect. Next. What if his total income is more than 12 lakhs? If total income is more than 12 lakhs, then also rebate is available under default tax rates. We will see another case. See, under default tax rates, if total income is up to 12 lakhs, rebate is available. Even if total income is more than 12 lakhs, then also rebate is available. What if total income is more than 12 lakhs? In that case, rebate is available in 3 steps. Step 1, tax on total income. Step 2, total income minus 12 lakhs. Step 3, if step 1 is greater than step 2, rebate is equal to step 1 minus step 2. If step 1 is less than or equal to step 2, rebate is equal to 0. You will not understand like this. That's why we will do one problem. You will get better clarity. So, Rahul, resident individual. First of all, he is individual. Condition 1 satisfied. He is also resident in India. Condition 2 satisfied. His total income is 12,25,000, which is more than 12 lakhs. So, condition 3 satisfied. His total income is more than 12 lakhs. Rebate will be calculated in 3 steps. First of all, before we calculate rebate, first let us calculate tax. Up to 4 lakhs tax is 0. Above 4 lakh up to 8 lakh tax rate is 5%. That means what? 4 lakh into 5% tax amount is 20,000. Above 8 lakh up to 12 lakh tax rate is 10%, tax amount is 40,000. Above 12 lakh up to 16 lakh tax rate is 15%. That means what? Here total income is only 12,25,000 na. So 12,25,000 minus 12 lakh into 15%, tax amount is 3,750. So overall tax amount is 63,750. Now 3 conditions are satisfied. Individual, resident in India, total income greater than 12 lakhs. In this case, rebate will be calculated in 3 steps. Step 1, tax on total income. How much is tax on total income? 63,750. Step 2, total income minus 12 lakhs. How much is total income? 12,25,000 minus 12 lakhs, 25,000. Step 3, we need to compare step 1 and step 2. Here, step 1 is greater than step 2, correct? 63,750 is greater than 25,000. Then only rebate is available. Otherwise, rebate is 0. As step 1 is greater than step 2, in this particular case, rebate is equal to step 1 minus step 2. 63,750 minus 25,000, rebate is 38,750. How much is the tax after rebate? Tax after rebate is 25,000. To this, we need to add health and education cess. Thereby, we arrived at final tax liability. Did you understand? So, very simple. Under default tax rates, if total income is less than or equal to 12 lakhs, rebate is equal to tax or 60,000, whichever is lower. If total income is more than 12 lakhs, then rebate will be calculated in 3 steps. Step 1, tax on total income. Step 2, total income minus 12 lakhs. In step 3, what you need to do? You need to compare step 1 and step 2. Only if step 1 is greater than step 2, then only rebate is available. Rebate is equal to step 1 minus step 2. If step 1 is less than step 2, then rebate is equal to 0. I hope you understood this. Okay, next. There is one point, third note point, please see. Rebate under section 87A is not available in respect of tax payable on special tax rates. What do you mean by this? You know special tax rates, right? Long-term capital gain under section 112A up to 1,25,000 exempt, in excess of 1,25,000 taxable at the rate of 12.5%. Long-term capital gain under section 112 taxable at the rate of 12.5%. Short-term capital gain under section 111A taxable at the rate of 20%. Lottery income taxable at the rate of 30%. So all these are special tax rates. Whatever the rebate under section 87A is there, that is not available against tax on incomes taxable at special tax rates. What do you mean by this? We will solve another problem. You are going to get clarity. Income tax is all like this. If you read the provision, confusion will be there. Once you solve the problem, you are going to get complete clarity. That's why I am here with you with good examples. The moment you understand the example, automatically you will also understand the concept. Okay. Now, Roy, resident individual, aged 48 years, default tax rates. First of all, he is individual, condition 1 satisfied, resident, condition 2 satisfied. He has long-term capital gain under section 112, 3 lakhs, short-term capital gain under section 111A, 2 lakhs, other income 6 lakh 80,000. So total income is 11 lakh 80,000. Out of 11 lakh 80,000, 5 lakhs is taxable at special tax rates. 6 lakh 80,000 is taxable at slab rates. The point is, against slab rates, rebate is available. But against special tax rates, rebate is not available under default tax rates. Okay, I will tell you. Let us solve the problem. You are going to get the clarity. So, long-term capital gain under section 112 is 3 lakhs, right? 3 lakhs into 12.5%, 37,500. Short-term capital gain under section 111A, 2 lakhs. 2 lakhs into 20%, 40,000. So, special tax is 40,000 plus 37,500, 77,500. Other income 6 lakh 80,000. You all know, up to 4 lakhs 0, above 4 lakhs up to 8 lakh tax rate is 5%. So tax amount is 14,000 rupees. Now total tax is 91,500. Here total income is less than 12 lakhs na. 3 conditions are satisfied: individual, resident in India, total income less than 12 lakhs. If 3 conditions are satisfied, rebate is tax or 60,000, whichever is lower. Correct? Here tax amount is 91,500. But can you claim 60,000? No. Here 91,500 is not eligible for rebate. Whatever tax on special tax rates is there, 77,500, that is not eligible for rebate. Only 14,000 is eligible for rebate. So 14,000 or 60,000, whichever is lower, that means only 14,000 is eligible for rebate. Balance is 77,500. To that we need to add HEC, thereby final tax liability is 80,600. So in one line, under default tax rates, rebate under section 87A is not available against tax on incomes taxable at special tax rates. Did you understand? So whatever special tax rates are there, on special tax rates, whatever the tax that you calculate, from that tax you cannot claim rebate under section 87A. I hope with this example you understood. Here income taxable at special tax rates is 6 lakhs and tax on it is 77,500. 77,500 is not eligible for rebate. Only balance tax 14,000 is eligible for rebate. Okay. Next, under optional tax rates there is no amendment. You already know. Under optional tax rates, rebate is tax or 12,500, whichever is lower. Another point is, under optional tax rates, rebate is not available only in respect of tax payable on long-term capital gain under section 112A. Okay, so under default tax rates, rebate is not available against any tax on special tax rates. Under optional tax rates, rebate is not available only against tax payable on long-term capital gain under section 112A. Did you understand? So that is the summary. Simple. Default tax rates. If income is taxable at special tax rates, no rebate. Optional tax rates. Income is taxable at special tax rates, rebate is available, but only against tax on long-term capital gain under section 112A, rebate is not available. Are you able to understand? Good. Next we will see amendments in PGBP. No deduction shall be allowed for expenses incurred to settle proceedings relating to contraventions or defaults under following laws. What are those laws? Securities and Exchange Board of India Act 1992, Securities Contract Regulation Act 1956, Depositories Act 1996, Competition Act 2002. See, under these four laws, if you have done any violation, that means if you violate any law, if you default any law, then penalty will be levied. Whatever the penalty that you have paid, penalty is expenditure. Correct? Penalty is also expenditure, but that expenditure is not allowed under PGBP. While calculating PGBP, that expenditure will be disallowed. That expenditure will not be allowed as deduction. So if you pay any penalty for violating Securities Exchange Board of India Act, Depositories Act, Competition Act, Securities Contract Regulation Act, for violating these four laws, if you pay any penalty, that penalty is expenditure for you, but that expenditure is not allowed as deduction while calculating PGBP income. Okay, next. Meaning of micro and small enterprise. See, you know section 43B, right? Whenever you received goods from micro enterprise or small enterprise, whenever you received services from micro enterprise or small enterprise, you have to pay amount on time. If there is no agreement, within 45 days you should make the payment. Then only expenditure is allowed on accrual basis, otherwise allowed as deduction on cash basis. We have studied, right? So, like there is definition, change in definition. That means micro enterprise definition is amended, small enterprise definition is also amended. What is the amended definition? So, micro enterprise means investment in plant and machinery should be less than or equal to 2.5 crores, turnover should be less than or equal to 10 crores. Small enterprise means investment in plant and machinery should be less than or equal to 25 crores, turnover should be less than or equal to 100 crores. So, easy to remember. Micro, plant and machinery less than or equal to 2.5 crores, turnover less than or equal to 10 crores. Small enterprise into 10, 2.5 into 10, 25 crores. 10 crores into 10, 100 crores. Okay, so micro enterprise, plant and machinery less than or equal to 2.5 crores, turnover less than or equal to 10 crores. Small enterprise, multiply with 10. Investment in plant and machinery should be less than or equal to 25 crores. Turnover should be less than or equal to 100 crores. That is the new definition of micro enterprise and small enterprise. Next, we will see amendments in capital gains. You know section 54 EC, right? Section 54 EC. Combination. Whenever you sell immovable property, whatever the capital gain that you receive, if you invest that capital gain in NHAI bonds, RECL bonds, Indian Railway Finance Corporation bonds, Power Finance Corporation bonds, that reinvestment is eligible for exemption under section 54 EC. Maximum exemption allowed is 50 lakhs under section 54 EC. Do you remember? But from 1st April 25 onwards, even if you invest in HUDCO bonds, Housing Development Corporation bonds, with effect from 1st July 25, even if you invest in IREDA bonds. IREDA means Indian Renewable Energy Development Agency. Even if you invest in these bonds, such reinvestment is eligible for exemption under section 54 EC. That is another amendment. So, till now, NHAI bonds, RECL bonds, Indian Railway Finance Corporation bonds, Power Finance Corporation bonds, only 4 bonds. From 1st April 25 onwards, another 2 bonds are also added. From 1st April 25, investment in HUDCO bonds. From 1st July 25, investment in Indian Renewable Energy Development Agency bonds. Even such reinvestment is also eligible for exemption under section 54 EC. Next. This is not 9 July, this is 1 July. Please change. I think 9 July only, I am sorry. Yes, 9th July 2025 only. Another important point is HUDCO bonds and IREDA bonds. These should be redeemable after 5 years. Only such HUDCO bonds and IREDA bonds are eligible for 54EC exemption. Let's say I sold house, I got 50 lakhs or I got 30 lakhs. I invested in HUDCO bonds redeemable for 3 years. Can I get exemption? I will not get exemption. Only if I invest in HUDCO bonds that are redeemable after 5 years, only if I invest in such bonds, then only I can claim exemption under section 54EC. Next, cost inflation index for financial year 25-26 is 376. You know, right? For calculating indexed cost of acquisition, indexed cost of improvement, you need index numbers. So for financial year 25-26, index number is 376. Next, amendments in business restructuring. We have discussed in business restructuring chapter, whenever amalgamation happens, whenever firm gets converted to company, whenever proprietary concern gets converted to company, whenever private company got converted into unlisted public company, whenever private company got converted into LLP, whenever unlisted public company got converted into LLP. In all these cases, losses of predecessor will be carried forwarded to the successor. In that chapter I have told, whenever this business restructuring happens, whenever amalgamation happens, whenever this conversion happens, successor will get fresh period of 8 years to carry forward losses of predecessor. I told in class also. But as per Finance Act 2025, fresh period of 8 years is not available. What do you mean by this? I will tell one example. Let's say in previous year 22-23, Vodafone has loss of 70 lakhs. In previous year 25-26, Vodafone got merged with VI. Now, till financial year 24-25, fresh 8 years are available. VI can carry forward losses for fresh 8 years. But when amalgamation happened in 25-26. From 25-26 onwards, fresh 8 years period is not available. That means what? Whatever the loss 70 lakhs belonging to financial year 23-24 is there, from 23-24 only 8 years period is to be counted. 24-25, 25-26, 26-27, 27-28, 28-29, 29-30, 30-31, 31-32. That means till financial year 31-32 only VI can carry forward the losses. Are you able to understand? Previously, whenever amalgamation happens, from year of amalgamation, fresh period of 8 years is available. But if amalgamation or business restructuring takes place after 1st April 25, then successor will not get fresh period of 8 years. Successor can carry forward losses as per general rules only. As per general rule, loss of an year can be carried forward for 8 years if it is non-speculative business. So, previous year 22-23 loss can be carried forward for financial year 22-23, that can be carried forward for financial year 30-31. Okay, that's what. Earlier, whenever business restructuring happens, successor used to get fresh period of 8 years to carry forward losses of predecessor. But from 1st April 25 onwards, if business restructuring happens, if amalgamation and conversion happens, successor will not get new period of 8 years. He will not get fresh period of 8 years. The year in which loss is suffered by predecessor, previous year 22-23. From that year, whatever the 8 years are there, previous year 30-31, till that previous year only, successor can carry forward the losses. Are you able to understand? So this is another major amendment. Now we will see amendments in deductions from total income. Do you remember 80 CCD 1B? You know 80 CCD 1, 80 CCD 1B, 80 CCD 2. Employer contribution to NPS, Central Government Pension Scheme, that is eligible for deduction under section 80 CCD. So let's say not only employer contribution, even employee contribution is also eligible. Actually, employer contribution is eligible for deduction under section 80 CCD 2. Employee contribution is eligible for deduction under section 80 CCD 1, 80 CCD 1B. Under 80 CCD 1B, maximum deduction allowed is 50,000. There is another scheme, central government employees. Generally, if you contribute to NPS, then only deduction is available under section 80 CCD. With effect from 1st April 25, not only contribution to NPS, even if you do contribution to NPS Vatsalya, who will open NPS Vatsalya? NPS Vatsalya scheme allows parents or guardians to open NPS account for their children. See, if I want to open NPS account on my name, I can open NPS account. If I want to open NPS account on my children's name, okay, then I have to open NPS Vatsalya account. So what they are saying, from 1st April 25, not only contribution to NPS, along with contribution to NPS, whatever the contribution that I am making to NPS Vatsalya is there, even that is also eligible for deduction. Are you able to understand? That means what? Contribution to my NPS account, contribution to my NPS Vatsalya account. These two contributions together should not exceed 50,000 rupees. Are you able to understand? So, contribution to NPS plus contribution to NPS Vatsalya, aggregate contribution is eligible for deduction under section 80 CCD 1B, but maximum deduction allowed is 50,000 rupees. Are you able to understand? So, contribution to NPS plus contribution to NPS Vatsalya. Both these contributions together, aggregate contribution should not exceed 50,000 rupees. Next, section 80 IAC. Generally, under this section, deduction is available for startups. Generally, if any startup is started between 1st April 2016 to 31st March 2025, then that startup is eligible for deduction under section 80 IAC. Now, the limit was enhanced. Earlier 10 years only. If you start a startup between 1st April 2016 and 31st March 2025. Now, this 31st March 2025 was increased to 31st March 2030. That means any startup started between 1st April 2016 and up to 31st March 2030, that startup is eligible for deduction under section 80 IAC. That means on 31st March 2025, 10 years period is over. From Finance Act 2025, that 10 years period is further extended to 15 years. Are you able to understand? Good. Next we will see amendments in return of income. See, as per Finance Act 2024, you can file updated ITR up to 24 months from the end of the assessment year. But there is amendment. As per Finance Act 2025, you can file updated ITR. You can file ITRU up to 48 months from the end of the relevant assessment year. So previously, once assessment year is completed, only 2 years is available to file ITRU. But from 1st April 25 onwards, to file ITRU, 4 years is available. This is financial year 25-26 over. Assessment year is 26-27. After 26-27 also, 4 years time limit is available to file ITRU. Are you able to understand? So, you can see financial year 25-26. What is the assessment year? Assessment year is 26-27. Okay. From generally, what is last date for filing belated ITR and revised ITR? Last date for filing revised ITR and belated ITR is 31st December 26. From 31st December 26 up to end of 12 months from the assessment year. See, when assessment year is getting completed, assessment year is getting completed on 31st March 27, correct? From 31st March 27, 12 months means 31st March 2028. So, from this period, that means 1st January 27 onwards. From 1st January 27 up to 31st March 28. During this period, if ITRU is filed, then penalty is 25%. You can see ITRU filed after expiry of time limit under section 139(1) and before 12 months from end of assessment year. Penalty is 25% of tax plus interest. If ITRU is filed after 12 months but before 24 months, then penalty is 50%. That means during this period, if ITRU is filed, penalty is 50% of tax liability plus interest. If ITRU is filed after 24 months but before 36 months, that means during this period, if ITRU is filed, penalty is 60%. If ITRU is filed after 36 months but before 48 months, during this period, then penalty is 75% of tax plus interest. Very simple. In assessment year, we will file income tax return. What is last date for filing belated ITR? 31st December. After that, you cannot file revised return, you cannot file belated return. After expiry of time limit for filing belated return, up to 12 months from end of assessment year. What is the penalty? Penalty is 25%. After 12 months from end of assessment year but before 24 months, penalty is 50%. After 24 months but before 36 months, penalty is 60%. After 36 months, before 48 months, penalty is 75%. Yes. So after 12 months but before 24 months, 50%. After 24 months but before 36 months, 60%. After 36 months but before 48 months, 75% of tax plus interest is the penalty. Next. See, nowadays, if you want PAN number, definitely you should give Aadhaar number. Only if you give Aadhaar number, then only PAN will be allotted to you, otherwise PAN will not be allotted to you. Sir, what if I do not have Aadhaar number? If you do not have Aadhaar number, go and first apply for Aadhaar number. When you apply for Aadhaar number, in the application, there will be ID given. So once you apply for Aadhaar number, then enrollment ID will be given. Using this enrollment ID, you can apply for PAN number. Today, let's say I do not have Aadhaar number. First, I will go and I will apply for Aadhaar number. It will take 1 month to come Aadhaar number. But when I apply for Aadhaar number, there will be enrollment ID in the application. Using that enrollment ID, I can also apply for PAN number. Are you able to understand? So, two ways. If I want PAN number, I should give Aadhaar number. If I do not have Aadhaar number, first I should go and apply for Aadhaar number. Enrollment ID will be given in Aadhaar application. Using enrollment ID also, I can apply for PAN number, correct? So, the thing is, before 1st October 24, whoever have applied for PAN using enrollment ID, before 1st October 24, you applied for PAN number using enrollment ID. After 1 month or 2 months, you should have got Aadhaar number. Now, after you get Aadhaar number, you should intimate the Aadhaar number to Income Tax Department. Are you able to understand? So, those who got PAN based on enrollment ID, when before 1st October 24, they should intimate Aadhaar number to Income Tax Department. What is the due date for intimation? Due date for intimation is before 31st December 2025. Are you able to understand? That is another amendment in Return of Income chapter. Now we will discuss amendments in TDS and TCS chapter. Lot many amendments came in TDS and TCS chapter. Roughly around 40% of the total amendments are from this TDS TCS chapter. So listen carefully, somewhat important. At CMA final level, he is not focusing that much on TDS chapter, yet it is considered important. You know section 206C1F, right? Whenever any motor vehicle is sold, if value of motor vehicle is more than 10 lakhs, TCS is required to be collected at the rate of 1%. The scope of that section is widened. Earlier, under section 206C1F, only motor vehicle is covered. That means only on sale of motor vehicle, if value of motor vehicle is more than 10 lakhs, then only TCS is required to be collected. With effect from 1st April 25, as per Finance Act 25, this section scope is widened. Not only on sale of motor vehicle, on sale of wristwatch, on sale of antiques, paintings, sculpture, on sale of collectibles such as coin, stamp, these are also antiques. On sale of any yacht, boat, helicopter, on sale of any sunglasses, on sale of handbag, purse, on sale of shoes, on sale of any sportswear equipment, on sale of any home theater system, on sale of any horse for horse racing, all these are covered. That means, let's say I am buying watch, Richard Mille watch. The value of watch is 50 lakhs. Let's say I am buying Rolex watch. The value of watch is 1.5 crores. On buying watch, whoever the seller of watch is there, along with value of the watch, he will additionally collect TCS at the rate of 1% under section 206C1F. That means what? Earlier under section 206C1F, only motor vehicle is covered. Now, what people are doing? They are buying costly watches. They are buying costly hats, costly, sportswear, costly sunglasses, costly purses, Louis Vuitton. Okay, so that's why not only motor vehicles, if you buy any of these and if value of these articles is more than 10 lakh rupees, seller along with value of the article, additionally he will collect TCS at the rate of 1% under section 206C1F. Next, reduction in TCS rate. If you remember, under section 206C1, forest produce, on sale of forest produce, timber best example. Earlier TCS rate is 2.5%, now the TCS rate is reduced to 2%. That means on sale of timber, earlier 2.5% TCS is required to be collected, but with effect from 1st April 25, TCS rate is reduced to 2%. Next, TCS on remittance under LRS for the purpose of education financed by loan from financial institution under section 80E. Let's say there is me, there is my brother. Let's say his name is Krishna. My brother is studying in USA. What I have done? I took education loan, 40 lakhs. Now, I wanted to remit 40 lakhs to university in USA. Before 1st April 25, how much is the TCS? For remittance, TCS is 0.5%. TCS rate is 0.5%. But with effect from 1st April 25, TCS rate is 0. That means what? From 1st April 25 onwards, if you take any education loan and that education loan you have remitted outside India, no TCS will be collected. Earlier, 0.5% TCS is used to be collected. Are you able to understand? So very simple. From 1st April 25 onwards, if you take any education loan and that education loan amount you are remitting outside India, on such remittance under LRS, no TCS will be collected. Next, increase in threshold limit for collection of TCS. See, under LRS, earlier threshold limit is 7 lakhs. That means what? Let's say there is my friend in UK. I wanted to transfer him 8 lakh rupees for his expenses. So before 1st April 25, if amount of remittance is more than 7 lakh rupees, TCS is required to be collected under section 206C 1G. But from 1st April 25 onwards, the threshold limit increased to 10 lakhs. That means what? From 1st April 25 onwards, only if amount of remittance is more than 10 lakhs, then only TCS will be collected. Earlier that threshold limit is 7 lakhs. That means before 1st April 25, whatever the amount that I wanted to send outside India, if aggregate of such amount is more than 7 lakhs, TCS used to be collected. But from 1st April 25 onwards, whatever the remittances that I wanted to do outside India, all those remittances together, aggregate remittances, if it is more than 10 lakh rupees, then only TCS will be collected. Okay. Next. Very good news. Section 206C1H, no more. That means this section is abolished. 206C1H is no more there. Okay. Next, TDS amendments. See, in case of insurance commission, earlier TDS rate is 5%. That means insurance company, before paying commission to the agent, if amount of commission is more than 15,000 before, TDS rate is 5%. Now the TDS rate is reduced to 2%. What do you mean by this? Let's say LIC is there, it is paying commission to its agent. Now from 1st April 25 onwards, LIC is required to deduct TDS at the rate of 2%. Are you able to understand? Good. Next, increase in threshold limit for deduction of TDS. Section 193. Under section 193, earlier there is no threshold limit. If you pay any interest, let's say from my friend I have borrowed money for my business and I am paying interest to my friend. On such interest I am required to deduct TDS with no threshold limit. That is earlier. But from 1st April 25 onwards, threshold limit is there. If amount of interest paid is 10,000 rupees, no TDS is required to be deducted under section 193. Only if amount of interest is more than 10,000, then only TDS is required to be deducted. Next, section 194, dividend. You know dividend, right? If amount of dividend is up to 5,000 rupees, no TDS is required to be deducted. That is before 1st April 25. From 1st April 25 onwards, threshold limit is 10,000 rupees. That means like companies before paying dividend, if amount of dividend is up to 10,000 rupees, no TDS is required to be deducted. Again, some conditions are there. Amount should be paid to a bank account, individual or HUF. that criteria is there, but threshold limit is increased from 5,000 to 10,000 rupees. Only if amount of dividend is more than 10,000, then only TDS is required to be deducted. Next, 194A, interest other than interest on securities. Best example, interest on fixed deposit, recurring deposit. So, on fixed deposit, recurring deposit, if any interest is paid by bank or post office or cooperative bank, earlier what are the limits? In case of senior citizen, 50,000. In case of normal citizen, 40,000. Those threshold limits are increased. From 1st April 25 onwards, in case of senior citizen, threshold limit is 1 lakh. Let's say my grandfather is there. He is around 70 years, for example. He invested 8 lakh rupees in FD. He got interest 80,000 rupees. On 80,000 rupees, no TDS will be deducted. Okay, because threshold limit is 1 lakh. Are you able to understand? So, in case of senior citizens, from 1st April 25 onwards, threshold limit applicable is 1 lakh rupees. In case of normal citizens, threshold limit applicable is 50,000 rupees. That means for us also, only if interest on FD is more than 50,000, then only TDS will be deducted. Otherwise, no TDS will be deducted. Next, 194B, you all know, winning from lottery, betting, gambling, horse races and all. Earlier, 10,000 rupees is the limit for all transactions. That means in 1 year, for all lotteries together, if amount paid is more than 10,000 rupees, then TDS is required to be deducted. But from 1st April 25, 10,000 rupees is for single transaction. That means for each transaction, if amount paid is more than 10,000 rupees for lottery winning or betting or gambling, then only TDS is required to be deducted under section 194B. Next, 194BB, winning from horse races, same amendment. Earlier 10,000 is aggregate limit earlier, but from 1st April 25, 10,000 rupees limit is for single transaction. Are you able to understand? Next, 194D, insurance commission. See, for 194D, two amendments. Threshold limit increased from 15,000 to 20,000. TDS rate decreased from 5% to 2%. So, very important, high chances this might be asked in the exam because two amendments are there in one section only. 194D, insurance commission threshold increased from 15,000 to 20,000. TDS rate decreased from 5% to 2%. 194G, income by way of commission, prize money on lottery tickets. See, whenever lottery conducting agency pays commission to lottery agent, on such commission, TDS is required to be deducted at the rate of 2%. Threshold limit was increased from 15,000 to 20,000. 194H, commission on brokerage. Let's say I am real estate dealer. I am paying commission to real estate agent. On such commission, TDS is required to be deducted only if amount of commission is more than 20,000 rupees. So, 194DGH. For these three sections, threshold limit increased from 15,000 to 20,000. Remember 20,000 from now. Next, 194I, rent. You all know, if amount of rent in a financial year is more than 2,40,000, then TDS is required to be deducted. That is before. From 1st April 25 onwards, 50,000 per month. That means 6 lakhs per annum. Only if amount of rent is more than 6 lakhs, then only TDS is required to be deducted under section 194I. Next, professional fees. Earlier, threshold limit is 30,000. If client pays me professional fees more than 30,000, client is required to deduct TDS. But from 1st April 25 onwards, I am a bit relieved. If amount of professional fees is more than 50,000, then only client is required to deduct TDS. So, under section 194J, threshold limit increased from 30,000 to 50,000. 194K, this is just like section 194 only. 194 is dividend on shares. 194K is dividend on mutual fund units. So, just like 194, even for 194K also, threshold limit is increased from 5,000 to 10,000. Next, 194LA, income by way of enhanced compensation. You know, right, whenever government do compulsory acquisition, government will pay compensation. If amount of compensation is more than 2,50,000, government is required to deduct a TDS at the rate of 10% under section 194 LA, that is before. But with effect from 1st April 25 onwards, threshold limit is increased from 2,50,000 to 5 lakhs. That means what? If amount of compensation on compulsory acquisition is more than 5 lakh rupees, then government is required to deduct a TDS at the rate of 10% under section 194 LA. Next, very important section. Chances are there this can be tested in the examination. Section 194T. TDS on payment by partnership firm to partners. Let's say partnership firm is there. Partnership firm makes payment to partners. The payment can be anything. The payment can be remuneration or salary or commission, or the payment can be interest on capital. Whatever the nomenclature you use, name anything you use, whether you say it remuneration, salary, commission, bonus, interest on capital, aggregate all these payments together. If aggregate payment in a financial year, if it is more than 20,000 rupees, then partnership firm is required to deduct TDS. Required to deduct TDS under section 194T at the rate of 10%. So did you understand? So from 1st April 25 onwards, if any partnership firm is making any payment to the partner, whether it is salary, remuneration, bonus, commission, on such payment, partnership firm is required to deduct TDS at the rate of 10%. Aggregate amount, not individual amount. Okay. Next. You can see on aggregate payment. Next, another good news, section 206AB, section 206CA. These two sections got abolished. These sections are not there. Next, benefits of tonnage taxation scheme. Like this is not that much important, but we discuss in regular batch. Generally, tonnage taxation scheme is not applicable for yachts and tour ships and all. They are applicable only for regular cargo vehicles. That too, if volume is more than 15,000 tons like that. But the tonnage taxation scheme recently is made applicable for inland vessels also. That is another amendment. That means within India also, whatever the inland vessels are there, if anyone is using inland vessels, for inland vessels also they can take benefit of tonnage taxation scheme. Next we will discuss trust taxation amendments. The validity period of registration for smaller trusts or institutions having total income not exceeding 5 crores in each of the 2 preceding previous years has been increased from 5 years to 10 years. What do you mean by this? In case of trusts, whenever I apply for trust registration and I get registration, my registration is valid for 5 years. After 5 years, I should go for renewal of trust registration, correct? Similarly, after renewal also, second time renewal is valid for 5 years. After 5 years, again I have to go for re-renewal, correct? But see, 5 years is very short period. So the government came up with amendment. Those trusts whose total income is less than 5 crores in last 2 previous years, for such kind of trusts, registration is valid for 10 years. Only after 10 years, they should apply for renewal. What do you mean by this? Let's say, in previous year, 24-25, I am applying for trust registration under section 12AB. In previous year 23-24, total income of trust is 4 crores. In previous year 22-23, total income of such trust is 3.5 crores. In last two preceding previous years, total income is less than 5 crores, right? So if I get registration in 24-25, the registration is applicable for 10 years. Are you able to understand? Or you can replace 25-26. I am applying for trust registration in 25-26. Income tax department will check a total income of last two preceding previous years, 24-25, 23-24. So in last two preceding previous years, if my turnover is less than 5 crores, then from 25-26 onwards, if I get registration, that registration is valid for 10 years. After 10 years, I should apply for renewal of trust registration. Are you able to understand? Good. Next, specified person. Earlier, any person who gives donation more than 50,000 is treated as specified person. But from 1st April 25 onwards, specified person definition is changed. Any person who gives donation more than 1 lakh per transaction or more than 10 lakhs in aggregate in a previous year, he will be treated as specified person. That means what? Let's say for a trust, Sri Salem Trust, I gave 15 lakhs donation. I will be treated as specified person. Are you able to understand? So for any trust, any donor, two criteria: individual donation more than 1 lakh or aggregate donation in a financial year more than 10 lakhs. Such donor will be treated as specified person. Okay. Earlier limit is 50,000. Now threshold limit got changed. 1 lakh individually, 10 lakhs aggregatedly. Another point, relative of donor is excluded. Relative of donor. Let's say I gave donation 5 lakh rupees in a single transaction. I will be treated as specified person. My relative is not treated as specified person. Relative of donor is not treated as specified person. Concerns in which such contributors is having substantial interest. Let's say in a company I have 40% shareholding. I am having substantial interest. That company is not treated as specified person. Are you able to understand? Simple. Donor giving donation more than 1 lakh per transaction or more than 10 lakhs in aggregate in a financial year. Only such donor is treated as specified person. Others are not treated as specified person. Relative of donor is not treated as specified person. If donor is having substantial interest in any company or any firm, that company or firm is not treated as specified person. Next. Registration or provisional registration cannot be cancelled merely because application is not complete. Let's say I am making application for trust registration. In that application, 2-3 particulars I forgot to give. Just because application is incomplete, registration should not be cancelled. Are you able to understand? Let's say in 25-26 I took trust registration. After 5 years I will go for renewal. At the time of renewal, in renewal application, if I fail to give 1 or 2 information, just because I did not give 1 or 2 particulars, 1 or 2 information, commissioner should not cancel my registration. Are you able to understand? So it cannot be cancelled merely because the application is not complete. Such incompleteness is treated as minor and rectifiable default. Another good news, equalization levy chapter is no more there. If you have attempted for December 25 attempt or June 25 attempt, I taught equalization levy. From June 2026, equalization levy chapter is removed from the syllabus. No concept of equalization levy. Next, see, in case of search, they used to levy penalty under section 271 AAB. But nowadays, after 1st September 2024, in case of search, block assessment was introduced. In block assessment, penalty is 50% of tax. We discussed in class. So in case of block assessment, already penalty is levied under section 158. So that's why earlier penalty section 271 AAB is abolished. So there is no, like, that section was removed nowadays. Earlier, whenever there is search that was conducted, penalty used to be levied under section 271 AAB, but nowadays that section was removed because penalty is levied under section 158 under block assessment. Next, in block assessment, there are amendments. See, undisclosed income includes virtual digital asset also. So, virtual digital assets are also included in undisclosed income. That means whenever raid is conducted, if department comes to know SSE is owning bitcoins, even bitcoin is also treated as undisclosed income. Next, time limit for completion of block assessment revised. So, from 12 months from end of the month to 12 months from end of the quarter in which such last of authorizations for such requisition is executed. See, what earlier, let's say today raid is completed, last of authorizations were given. For example, let's say 12th February 26, let's say today raid completed. So what is end of month? 28th February 26 from this 12 months. That means 28th February 27. This is time limit for completion of search. Assessment. Block assessment. This is earlier, but this provision is no more there from 1st April 25 onwards, with effect from 1st April 25. What is the provision? 12th February 26 is there. You need to take end of the quarter. So February end of the quarter is 31st March 26 from this 12 months. That means 31st March 27. This is the new time limit for completion of block assessment. Okay, did you understand? So 12 months from end of the quarter, that is very important. Earlier 12 months from end of the month. So this is the difference, month, quarter. Okay, next. Time limit for imposing penalties. An order imposing penalty shall not be passed after expiry of 6 months from end of the quarter in which the connected proceedings are completed, the order of appeal is received, or the order of revision is passed, whichever is applicable. Let's say I fraudulently claimed HRA exemption 7 lakhs. Now department passed demand order. They done assessment under section 143(3) regular assessment, and they passed demand order 3 lakhs tax liability. What I did, I applied for appeal. In appeal, judgment came today. Judgment came, I lost. That means what? Department won the appeal. When judgment came? 12th February 26. Generally, if I fraudulently claim HRA exemption, it will become misreporting of income. In case of misreporting of income, 200% of tax is levied as penalty, correct? Underreporting of income, 50% of tax penalty. Misreporting of income, 200% of tax is penalty. To levy penalty also, there is a time limit. For example, what is the time limit? Judgment received today. Appeal order received today. 12th February 26. What is the time limit? 6 months from end of the quarter. That means end of quarter is 31st March 26. From this 6 months means 30th September 26. That means on or before 30th September 26, they should levy penalty. For example, department forgot. Department raised penalty on 15th October 26. That penalty order is time barred. Okay, that is after completion of time limit. So department can levy penalty, income tax department can levy penalty, but there is time limit. Income tax department should levy penalty within 6 months from end of the quarter in which appellate order is received. Are you able to understand? So that is another amendment. Next, section 276 BB has been amended to grant exemption from prosecution for delayed payment of TCS where such tax is paid on or before the due date for filing the quarterly TCS statement. See, once you collect TCS, you should pay TCS to the government. If you fail to pay TCS, minimum 3 months, maximum 7 years imprisonment is there. Okay? So, the thing is, in February I collected TCS. On or before 7th March, I should deposit TCS to the government. Otherwise, income tax department can prosecute me, can imprison me for minimum period of 3 months and maximum 7 years. But this punishment was little bit relaxed. Let's say in February, I collected TCS. What is the due date? Due date is 7th March, right? Due date is 7th March 2026. What is the TCS return due date? TCS return due date is 31st May 2026. Correct? So, on or before 31st May 2026, if I pay TCS, then no imprisonment. Okay? That means what? Even though after collecting TCS, you did not pay TCS to the government, you have time up to due date for filing TCS return. Before due date for filing TCS return, you should pay TCS to the government. If you pay TCS, you will not be prosecuted, you will not be imprisoned. Only if you pay TCS after due date for filing TCS return, then only prosecution proceedings gets attracted. Then only you will be imprisoned in the jail. Are you able to understand? Earlier, if you fail to pay TCS before the due date, chances are there you will be prosecuted. But now relaxation is there. Even though you do not pay TCS, take some time but pay before TCS return due date. Then you will not be prosecuted. Are you able to understand? Next, section 115 AD. You know, long-term capital gain is taxable at the rate of 12.5%. But as per Finance Act 2024, in case of foreign institutional investors, on long-term capital gain, tax rate is only 10%. To harmonize, to make it applicable universally, even for foreign institutional investors also, if they get long-term capital gain from 1st April 25 onwards, tax rate applicable is 12.5%. That means what? From 1st April 25 for any person, whether he is foreign institutional investor or not, for any person, tax rate applicable for long-term capital gain is 12.5%. Are you able to understand? Yes. Next, block transfer pricing assessment. Transfer pricing is very important chapter at CMA final level. But there is only one amendment in transfer pricing chapter. See, let's say I am into export business. Let's say I am exporting steel bottles to my associated enterprise. That means what? I am doing international transaction. Whenever I do international transaction, obviously transfer pricing provisions are applicable. I am doing same transaction in 24-25, same export, 25-26, same export, 26-27, same export. Every year I am doing same transaction, every year assessing officer coming and every year assessing officer is calculating arm's length price. I am feeling headache, I am feeling stressed. Are Baba, every year assessing officer comes and he will calculate a new arm's length price. Every year whenever arm's length price is changed, automatically secondary adjustment will be done and I need to pay tax. From income tax department point of view also, it is burdensome. Every year they should calculate arm's length price. So to give some relaxation, lawmakers came with amendment. Whatever the arm's length price that is calculated for one previous year is there, the arm's length price can be applied for next 2 consecutive previous years. Let's say arm's length price is calculated for financial year 25-26. Let's say arm's length price is 3.5 crores. Now the same arm's length price will be applied for next 2 consecutive previous years. It will be applied for previous year 26-27 and previous year 27-28. So to reduce compliance burden to SSC and to also give relaxation to income tax department, lawmakers came up with amendment. Whatever the arm's length price that is calculated for one previous year is there, the same arm's length price will be applied for consecutive 2 previous years. Are you able to understand? That's it. But to get this benefit, SSC should exercise the option. Only if SSC exercises the option, then only arm's length price for one previous year will be applied for next 2 consecutive previous years. Otherwise, it will not be applied. Are you able to understand? So you can read this. Arm's length price determined for an international transaction for one previous year can be applied to similar international transactions for the next 2 consecutive previous years. SSC must exercise an option for applying same arm's length price to next 2 previous years. Once application is made, within 1 month, transfer pricing officer will pass the order. But this concept of application of arm's length price for 1 year to next consecutive previous years is not applicable in case of search. Once income tax department has done raid, income tax department has done search, then you cannot tell apply last year arm's length price for current year arm's length price. Like, you should not tell like that. See, what is general rule? Once arm's length price is determined for 1 year, the same arm's length price is applicable for 2 consecutive previous years. This provision will not be applicable whenever raid is conducted by income tax department. So whenever raid is conducted in that year, freshly arm's length price can be calculated by assessing officer. Next, section 44 BBD. Presumptive taxation for non-residents providing services or technology to electronics manufacturing in India. Let's say there is one company, DEL Limited. It is manufacturing iPhones. To manufacture iPhones, it needs some technology, right? So the technology is provided by US company. There is a company called Verizon. Verizon is giving technology to DEF Limited for manufacturing of electronics, let's say iPhones. Now DEF Limited will pay fees, right? Now out of that fees, 25% will be treated as presumptive income. Presumptive income under section 44 BBD. So whenever non-resident gives technology or services to Indian company or Indian person who is engaged in electronics, manufacturing electronics, on that whatever the professional fees that is taken, out of such professional fees, 25% is treated as presumptive income under section 44 BBD. And see, generally there will be an option to declare lower presumptive income. Let's say Verizon wants to declare only 20% as presumptive income. That option Verizon does not have. See, last line, option to declare lower profits is not available for above presumptive income. That means mandatorily they should declare at least 25% of fees as presumptive income. They cannot declare lower income as presumptive income. So this is recent section 44 BBD. So these are the amendments that are applicable for CMA final June 2026 attempt. If you get any doubt, you can reach out to me through this number. Most of the times, please don't call, keep a message. I will revert back to you in 24 hours. Soon I am going to do marathons for June 26 attempt also. Start following my channel. It will be very useful for you. Thank you very much. Bye.